Good afternoon, everybody. Whoa, there's the voice of God. Good afternoon, everybody. Thank you for joining us in this panel. It's nice to see some familiar faces here in the audience. Hey, Andy, nice to see you. And I'm really excited about this panel discussion we have today because it's a very, very timely issue. This is the topic I'm excited about talking about here is the issue with working families, inflation, and how we can use fintech to solve some of poverty's more pressing problems. Working families are facing a time of sustained and rising inflation. Energy costs, food costs, and just everyday life has gotten much, much more expensive on an increasing basis. Workers are all too often seeing their paychecks lag behind. Businesses are also facing a difficult time hiring. As we enter into this time of economic hardship, we know that households will face financial hardship. And we also know that reducing that hardship is going to require policymakers, for-profit institutions, not-for-profit institutions, and everyone in between to come together to explore new and innovative ways to improve access to financial institutions. Too often, when individuals fall short of money, they either have nowhere to go or the places they turn end up costing them more than they can afford, and it puts them into a long-run problem in a tailspin. As policymakers look toward reducing costs for Americans looking to access financial services, we know that new financial technologies can be helpful in this goal. We've seen technology disrupt and reduce costs for consumers in a wide variety of industries, and the financial services industry should also be subject to this disruption. But as this occurs, we also need to ensure that these new technologies also have consumer protections that ensure that individuals are not taken advantage of. This, in my opinion, will require a light but real touch by regulators in this arena. This is why I'm very excited about the panelists we have here before us today. We have individuals who are on the cutting edge of payment technologies, such as earned wage access, as well as some of the foremost scholars and individuals thinking through these issues. I want to quickly introduce our panelists and then get into some Q&A. And then for the audience, I'm going to be coming to some of you as you raise your hand, so start thinking about your question as well. First, we have Ram Palaniappan. Ram is a financial tech entrepreneur, someone I've known quite well for some period of time. His mission is to meet the unique needs of those living paycheck to paycheck. He's a serial entrepreneur, an engineer. I want him to tell his story about what Earn-In is and what earned wage access is. But just to briefly summarize, Earn-In currently helps people from more than 400,000 companies access wages that would have been otherwise held up in the pay cycle. We're going to talk a lot about the pay cycle in this panel today. Ram holds an MMS from the Birla Institute of Technology and Science and an MBA from Purdue University's Krannert School of Management. Next, we have Ida Rademacher, right?
Yeah, that's right.
Ida Rademacher, I just want to make sure I get it right. From the Aspen Institute. She's vice president of the Aspen Institute. Ida is VP there, and she's an executive director of the Aspen Financial Security Program. Since joining the Institute in 2015, Ida has combined her expertise in economic inclusion, research, and policy with her reputation as a collaborative and creative thinker to expand the FSP's effort to bring to the national forefront a solutions-focused discussion of how America can actually improve economic growth by addressing growing levels of wealth inequality and household financial insecurity. Her efforts have resulted in the creation of several new cutting-edge initiatives, including the Expanding Prosperity Impact Collaborative and the Reconnecting Work and Wealth Initiative and the Aspen Leadership Forum on Retirement Savings. Through these leadership projects, Ida and her team and others are building a cross-disciplinary community of leaders and change agents who, together, are deeply probing critical financial challenges facing U.S. households and shaping markets and shaping policy innovations that can improve the financial security and well-being of all Americans. Next, who came all the way from the Brookings Institution, next door, we have Erin Klein, senior fellow at the Brookings Institution. Erin is a senior fellow in economic studies at Brookings. He focused on financial technology and regulation, payments, macroeconomics, and infrastructure finance and policy. Prior to joining Brookings in 2016, he directed the Bipartisan Policy Center's Financial Regulatory Reform Initiative, Between 2009 and 2012, when we were at similar stints, he served as Deputy Assistant Secretary for Economic Policy at the Treasury Department. He also worked on financial regulatory reform issues, including crafting and helping secure passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. He was a Senate banking staffer at the time, if I'm not mistaken. He also played leading roles in responding to the economic crises, housing finance reform, transportation and infrastructure policy, and Native American policy. So we have here a panel that is expertise in this area. So I want to start with you real quick, because you've taken a very good macro view of these things. We're here to talk about financial inclusion, but fundamentally we're talking about financial inclusion because we care about financial well-being. What is missing in your assessment from our current financial services marketplace that promoted you to lead the initiative to call on the Treasury for a national strategy on inclusion? Why did you do that? What is lacking that called for that?
Yeah, thanks, Paul, and thank you so much, AEI, for hosting. It's great to be here having this conversation. I love having an in-person crowd and look forward to the Q&A later. The upside part of that answer is that there's probably more going right for real financial inclusion that leads to well-being than we have had in a long time in terms of the financial service, with the levels of innovation and the levels of leadership in the public sector and the private sector. The reality, though, is that the sum is still not greater than the parts. There are lots of different siloed initiatives. There are lots of innovations. We'll hear about some today. There are lots of beginning to be understanding about what it really takes to deliver well-being for a household, what gives them dignity and agency and choice. But there's still not a bird's eye view of how all the different pieces connect, because people's financial lives aren't siloed. The payments pieces and the savings pieces and what's going on day to day and to week is still not connected. So we ended up supporting what Treasurer Coons had called for, what Senator Coons had called for with a National Financial Inclusion Commission, a presidential commission. And we wanted to see how much support was out there. It was really this idea of a North Star being financial well-being for all households, and what is the financial infrastructure that can deliver on that. We certainly saw that during COVID, when all of the payments to households and businesses were hung up with some of those last mile problems. And to our delight, over 110 companies and civil rights organizations, every industry association related to finance in all sectors signed on in support of the idea of a comprehensive, coordinated government quarterback to help think about financial inclusion as a foundational piece of inclusive growth in this country. So we think it's the right time. There certainly seems to be the private sector will to do this, and I'm happy to talk about how, in particular, the components, as we come into a very inflation-driven environment, will matter for households.
Real briefly, where are we in the stage of the effort?
We've made a call, this growing stakeholder coalition, and you're always welcome others to ask about it, is in working groups and helping to inform, and we're continuing to find support on the Hill and support inside of the administration for it. So it's not a done deal, but there seems to be a through line to get this done.
Okay. Ram, I want you to tell us your origin story. I've heard it. I think some of the other panelists have heard it. It's really interesting. You're on the cutting edge of payment technologies. Tell me, what is earn-in? What is earned wage access? And what possessed you to even get into this in the first place?
Yeah, sure. So the way earn-in started quite by chance. I was running another company, and out there I found out that some of my employees were getting overdraft fees and payday loans. And it didn't make any sense to me because I thought I was paying them well. So I spoke with one of them, and the problem she had was she needed money the next day, couldn't wait till the following Friday. And it was Wednesday, and so I said, we'll just pay you for the days you already worked. And then I tried to get our payroll system to do that, and the payroll system couldn't do it. And kind of out of frustration, I said, well, fuck that. I just give you the money for the days you already worked, and when the payroll system finally does its thing, then you pay me back. And so it started off like that. I landed up doing this for a handful of my employees. For a couple of years, it was always in person. So they would see me in the office, and then this would happen. And then I moved, this was in Cincinnati, I moved to the Bay Area, and they wanted to know if I would still do it for them, and I didn't mind doing it because I knew how the systems worked, and I could tell if they were still working or not. So I continued to do it for them. Initially, it was over Messenger, and then that's not the most convenient way because I'd be like with someone, and then I keep getting messages. And so I built a really simple web form and said, if you need money, just fill out that form. And when I had this web page up, then people who I didn't know tried to use it. And so I did it for them as well. And what I realized is that if you give somebody access to their money when they need it, their life is much simpler. They're paying all their bills on time. No more late fees on bills, no more overdraft fees, no more payday loans. And so that's when I realized that if I didn't try to make it into a product that scales to more people, I'd always feel bad about myself. And it's kind of interesting, like this whole concept of pay cycles. Till the Industrial Revolution, people were paid every day.
That's right.
And that was when we started paying people in batch. It's like that's very much like in favor of companies, not in favor of people. Like as employees, if we had a choice, we'd all rather get paid 2 weeks before we go into work.
Yeah.
But it's not that way. Everyone gets paid 2 weeks after you work. But it doesn't have to be that way. Like the technology exists. I mean, in a way, like if you're comfortable with the technology, it's almost crazy that it runs in a 2-week batch. Nothing else runs in a 2-week
Actually,
batch.
the house side of the hill, if I'm not mistaken, it's 1 month batch, right? Yeah, it's 4 weeks. So, but go on, please.
I mean, just imagine if Google said, give me all of your searches, and every 2 weeks I'll give you your results. Like, you wouldn't even think of a system like that, but that's the kind of payroll system that we have.
But you just did this for your employees at your business. You built a crude web page. Did the concept of earned wage access exist then? Were there other people doing this? Or you just
Well, so it was happening informally. I think in lots of small businesses, the manager or the business owner was doing this for their employees.
Yeah.
So it wasn't done in a way that scales.
What year was this?
So I probably started doing it like in person, maybe 2008, 2009. Okay. And then we made it into a company only in 2013.
Wow. That's really, really something interesting. So Erin, I want to get your basic reaction to that, but you think a lot about payments. You think about how they affect workers in a fairly, very unique way. What, from your perspective, does government need to do to make the payment system function better for working class citizens, either directly or by allowing businesses to serve customers in a way that isn't currently done because of regulations? So what is wrong with the system today? What is wrong with the regulations of the system today? And what should be done about it?
Thank you for the question, Speaker Ryan, and thank you, AAI, for hosting this really important conversation. I'm going to start out with the fact that I think everyone in this room can agree with. Friday is going to be September 30th is going to be a Friday, right? We can all stipulate you don't need more analysis. So what happens if you get paid on Friday, September 30th? You have a check. You go to deposit in your bank. It's going to be there Tuesday, October 4th, maybe. At some point, not quite clear when in the day, it'll magically get credited to your account. What do you do for the weekend? How do you live? How do you pay rent? How do you handle all the automatic bills coming into the month, right? 40 to 50, 55% of Americans are living paycheck to paycheck at some level, right? We've designed a system that assumes you always have money and assumes you don't care when the money comes in. And that assumption works great for the half of Americans who always have $1,000 in their account, who get free checking, who get all these other benefits. And who's paying for that system is the people who are living paycheck to paycheck. Overdraft fees. 1 out of 11 Americans pay $350 a year or more in overdraft fees. Heavy overdrafters. They're the ones subsidizing free checking. You ask the question, why do we have this system? Right? The rest of the world has real-time payments. Bank of England did it in 2008. Bank of Mexico, Bank of Brazil, 2005, 2006. Europe was a little complicated. They had a few legacy systems in the European Union. They got it in 2019. Right? We don't have it. Why? The Federal Reserve chose not to do it. Simple policy choice. What's been the ramifications of that? By my calculations, over $100 billion of wealth have been transferred from people living paycheck to paycheck to payday lenders, check cashers.
You said $100 billion?
$100 billion. If we'd done real-time payments when the Bank of England did it in 2008, right? There was something brand new coming out. It was called the iPhone. That's the technology state that we were in. England in 18 months did real-time payments. We still don't have it, right? The private sector has developed some alternatives, earned wage access, real-time payment network, other things. But we made a critical mistake. We put the Federal Reserve in charge of regulating the nation's payment system, how fast that check clears, when that money comes into your account. But they're also in charge of operating their own system called the Automatic Clearinghouse, ACH system. So they're the operator and regulator. If we told Blockbuster, you're in charge of developing streaming, would we have Netflix? That's a mistake that we've made. And the people that have suffered have been the people living paycheck to paycheck. And the people that have prospered have been the banks regulated by the Federal Reserve and overdraft fees, the check cashers, the payday lenders, right? The people that weren't so fortunate to have a good boss that took care of you and ended up going to somebody a little bit less reputable. And it's really infuriating to me because the rest of the world is light years ahead of us in this.
Okay, so give us something good to talk about here. I mean, give us the glass half full. Well,
I mean, the glass half full is that one, you have some companies stepping in to bridge the gap. Two, you have some financial services banks that are trying to do the right thing and move forward on the overdraft stuff, reduce their punitive fees, do some other things. You have early wage access, you have technology, you have companies like Square and Uber that are trying to pay their workers and move things. You have a company like Visa who's figured out a hack to the system to do something called push debit to kind of reverse a transaction so they can clear things faster, right? And then you may have this thing called Fed Now that the Fed says they're going to start operating. It's taken them 7 years since they said they were going to start studying it. They had a thing called Fed 2020. They were going to have this solved by 2020. That was 10 years ago. They started this thing. We still don't have it. I'm very skeptical of those initiatives. I think we actually made huge mistakes in our COVID distribution payment. We had millions of Americans waiting on paper checks that were coming to them in September, October from March 2020.
Yeah.
Right? By one report showed over $60 million of CARES Act money went to check cashers by folks of that. So technology and private sector folks are making some progress. And they're doing workarounds and innovative hacks because they're real problems facing real Americans every day.
Okay, so Ida, let me ask you then. So where are good workarounds occurring? So you're at the beginning of this effort to get a whole of government approach to take on this.
Yep.
Where are any promising movements in government and obviously in industry that you see steps in the right direction?
Yeah, I mean, I think a couple of things with this. What earn in Ron, with your personal story and with your engineering mind, right? You focused in on a specific problem. This is what entrepreneurial solutions and underlying technology can do. You can focus on specific pain points and solve for them, and prove that you can do that in a way that has a business demand and that is solving real problems and saving households money. The problem in the long run, as you have an era of tech, is that you end up with 47 different apps on your phone, with 40 different slices of your financial life being managed, and we haven't actually centered on the full curated set of not just apps, but systems that people need. Payments need to work. Government to people payments, government to business payments, payroll systems need to work for households. And we know, in terms of household financial well-being, people just, it's not rocket science. What we've found over and over, and this is research that bears out in the qualitative and quantitative work, is people just need routinely positive cash flow. Just like a small business, people need to experience routinely positive cash flow in their life. That can be from their earned income coming in when they need it. It can be from the ways that non-labor income comes in to their life. Well, so an EITC payment or a Social Security payment. When your income is lumpy and your expenses are lumpy, and you can solve it for technology. The good news is that government it needs to understand that from a regulatory perspective, and it needs to understand it from what it can do to facilitate market innovation, and to the degree that finance is becoming a bit of a utility for households in this country to be fully participating in their economic life of the country. We need to solve it not in one-off ways, but thinking systemically. One of my colleagues often says that when you're the 50% of folks who have $1,000 in the bank, or more, systems behave for you. When you're not, when you're the other half of that, you behave for the systems, and it ends up taking an awful lot of your life, and that means that you don't have enough of the mental bandwidth or plain out time to be there for your kids, to think about the next step of education you might want to take. You're so busy managing this complicated financial life, and you're an exquisite manager of that. People who live on the margin have incredible ability to understand the complexity and manage it. But we can make it easier and it can be good for the economy, and I think it can lead to more innovation over time. But right now, all of the innovation isn't adding up to well-being for households in the way that it should, given the level of investment going into that space right now.
Okay, let's pick off that then, Ram. So well-being for households. How do you approach this? How does earned wage access approach this? How did you at EarnIn decide how to do this? And since we talked about how inflation is eating away at paychecks, how does your product help workers cope with inflation? And how does that compare to the other options they have, which are payday loans, overdraft, high credit card fees? So how does EarnIn and earned wage access tackle this?
Yeah, so you see the individuals using earned wage access as like a tool to help them get to a better place. And some of the data that we see is our customers, just the people who use EarnIn, they're saving about $1 billion a year in overdraft fees. So there's a lot of like cost avoidance happening.
And these are your customers, just earnings.
Just our customers are saving $1 billion a year in overdraft fees. I think there's a little bit of like a ripple effect because of that. You're now seeing banks reduce their overdraft fees because it's now no longer very attractive. And so it's helping everyone because overdraft fees are coming down.
What's a typical overdraft fee?
The most common one is $35.
$35.
$35 on the average transaction is $42, and it's usually paid back in 3 days when the paycheck hits. So it's
$35 fee and a $42
yes
charge.
And I think 1 in 12 of like the streaming services transactions, 1 in 8 of the streaming services transactions leads to an overdraft fee. So just think of it like for
Hulu.
yeah, like so for every $100 that they make, the banks make $40, which is amazing on the overdraft side. Aaron, you'll have great stats on this, I'm sure. But there's like bills being paid on time, so there's less late fees on bills. Interestingly, we see an income effect as well. So we're seeing wages go up when someone starts using our product. That happens in a couple of different ways. So our customers typically can't lock $50 or $100 in their gas tank. They're buying gas $5 or $10 at a time. And then if something unexpected happens, they don't have money to buy gas and they miss work. But with our app, they can download the previous day's earnings, and then they go into work and they make a full day's wages. So we're seeing the average hours worked go up by about 2 to 3 hours a week, and so their income goes up. There's also like just lots of other interesting mechanisms in which we're seeing wages go up. So one story that we got was from a customer who works at retail, and there's different types of jobs at retail, and some here are tied to a branch. And there's a better step up. There's a step up where you get to like manage that department in multiple branches. So you get a higher pay for that. She was offered that once, and then she couldn't take it because she had to front the gas money and then get reimbursed.
She denied herself this advancement, this employment opportunity.
Yes,
because she didn't want to front the gas money.
Exactly. And then when this next time when she got that offer, she had her app, and so she took it because she knew that she could now like manage that. And so you see things like that as well, where we're seeing incomes go up when someone has access to their wages.
So walk me through how does this disrupt the payday lenders? And because before, in the old days, which is 10 years ago, if somebody's really strapped, they need to get their car fixed because to get to work, and they didn't foresee this, and therefore it's either lose the job or fix the car. I'm going to the payday guy on the corner, and I'm going to get this loan, and then I'm going to end up paying these exorbitant interest rates if I, break the terms. What is this doing to that industry?
So
I'm sure this industry sees it as a disruption coming to them. Walk me through that.
Yeah, so now they have an alternative. If you look at how much, the median bank balance for our customers is $125. And so the way they make decisions, if that's how much money you have, is you're just trying to get to payday. You don't worry about how expensive it is as long as the payment is due after payday. That's why they take the overdraft fees. And overdraft fees are not happening by mistake. People are using it as a tool to get by. And so you have $125 in your bank account. You have about $645 as the median accrued but unpaid wages. And so when we give someone the ability to see how much money they have in total, now they have $765. And the way you make decisions is different. Because now you're trying to make the best decision for you. You're not trying to make a decision to get to payday. And so you can, you can buy things at the right point in time. You're going to pay your bills on time. And so you kind of like make people act like they were a step up from where they were and they start making better decisions.
And not going to payday lenders. Erin, what happens if banks reduce or eliminate overdraft fees? Will consumers, like low-income consumers, still end up paying for the loss of those overdraft fees in other ways?
Right.
Are we pushing on a balloon? How does
So
this work?
it depends how that's done, right? So you've seen some banks completely eliminate overdraft, right? By the way, most of the ones that do that also then decide to give you earlier access to your direct deposit. Notice the similarity that Rob's talking about. The timing of the access to the money, the more they can hold it, the more profitable they can make. When they give up the overdraft profit, then it doesn't make sense to hold the money for so long, right? We could solve this, you asked for glass. The Federal Reserve could put a regulation out tomorrow requiring you to have the first $5,000 to every check you deposit when you walk out the door. They have that legal authority, have had it since the Expedited Funds Availability Act of 1987. But they're never going to do it because their own system couldn't process their payment that quickly, and they're going to preference operating a payment system versus regulating the payment system. So you're seeing the banks that are giving up, and these are predominantly larger banks, right? A lot of larger banks have cut their overdraft fees and changed their policies, started to give people up to $50 or $100 without doing that. There's a group of small banks for whom overdraft is the entire business model. Ever heard of the bank Wood Forest?
No.
$9 billion bank. It has made more money in overdraft fees than Citibank for the last 7 years.
Wood Forest, where are
Wood
they?
Forest. They branch in Walmarts. They're located in a couple states. There's one in Prince George County, Maryland. There are a few in Maryland, often in the Southeast. They made over 100% of profit on overdraft fees in the last 7 years. So they've lost money in everything else they do. There's another bank, Armed Forces Bank. Want to guess who they serve on military bases? You want to talk about people who are living paycheck to paycheck? Think about our enlisted personnel, a lot of whom are overseas and deployed and have all sorts of financial hardships, right? There's a group of institutions that have targeted this overdraft customer, right? Another point.
Like payday lenders do.
Well, exactly.
Yeah.
Every single payday loan goes to a person with a bank account. Why do I know this? The only way to get a payday loan is to hand a post-dated check. My research has shown 70% of customers at a check cashing store have a bank account. There's a big misconception that these problems of payday lending and check cashing are problems of the unbanked.
Oh, interesting.
Wrong. They're problems of the underbanked. They have a bank account, but they're going to an alternative financial provider like this or a Western Union. 15 to 20% of Americans fall into this category, according to the FDIC. And they're going there because the services provided by mainstream financial institutions are not services that work for them. And so, to some degree, banks are voluntarily, and I commend the banks who are voluntarily lowering their overdraft fees. Bank of America just went from 35 to 10. It doesn't cost them $35 to give you an overdraft, right? It's a punitive amount, specifically designed originally to encourage you not to do it.
Yeah.
Now, some institutions reorder your debits and credits from the largest to the smallest because that maximizes their fees, because we're not yet in a real-time payment system for no good reason, but right, deal with the reality that you are. And so there's competitive pressure thanks to fintech companies that are doing this. There's some general good perspectives of this, and there's some recognition that this system isn't going to work. But ultimately, I don't think we're going to get to a workable solution without a regulatory regime that puts people first and reorders. We have a financial system where the less money you have, the more money it costs you to access your own money.
So let me go to an entrepreneur then about this. So policy people,
Yep.
DC people, you think differently. You're an entrepreneur. You look at this from different angles. Ram, what in your opinion should government do to help make this disruption really spread nationwide? What should we do to get these kinds of fintech services and these kinds of innovations through a regulatory structure in the hands of working Americans?
Yeah, so I think one is just to recognize how innovation and tech can be a force for good. It's just like the things that we already see with our own product, where overdraft fees are coming down, incomes are going up, but we also see lots of non-financial benefits where people are for the first time celebrating anniversaries and birthdays on the right day. And there's a whole bunch of benefits. So I think to recognize that innovation can be part of the solution. I think the second, and to follow the data that also shows that. The other piece I think is to be receptive to paradigm changes. And so one of the things that we've done is we've kind of made the employee be at the center of payroll instead of the employer. Mm-hmm. And that's an unusual paradigm, but it works. And it's let us spread to 400,000 companies. We have,
And that's because of technology now.
there's no way to do that without technology.
Yeah.
And we have 100,000 companies that have less than 20 employees who are using our product. And if you had to do it the way the prior generation did things, it was always with integration with the partnership with the company. You leave out all the small
How
businesses.
many people have the Earn It app?
Several million.
Several million.
Yeah.
So you must see data constantly and continuously.
Yes, and we actually, we see it, so we have a really good pulse on what's happening with the customer base. And some of the data has been used at an aggregated and anonymized level for some of the policy responses, like with what was happening during COVID.
Yeah.
And then I'll add one more thing on like how to like think of like technology side from a, like for policy makers. I think it's like to be willing to question why things work the way they do. I mean, one of the things that baffles me so much, like for all of you out here, like you've all been working this morning, and so you've earned some money. When you open your bank account, why is the money not there? And it's because it's not in your bank system, it's in a different system. Like that's the most trivial thing to do with technology, is to move data from one computer to another. Like it happens a million times a second. But why is it not in your bank account when you've worked today? And like, it's not because of technology. And so like there can be a policy approach to make sure that you get your money as you're working every second. And like it'll eventually happen. Like you see everything that is batch eventually becomes continuous, and so we'll get there. But there's all of these things like who benefits from having like a 2-week pay cycle? Definitely not the employee.
Can I add to this?
Please.
From Rob? I think what you said about centering on a household and how your business model is built on listening onto that. I think that is one of the best advances that not just FinTech 1.0, but the whole idea of embedded finance and where blockchain can even take us will be very much about figuring out what's really needed by consumers. The banking systems that we have and the regulatory systems that have grown up around them are all about managing the risk of the system for the system. I think that the realities that we all experienced during COVID are that one of the risks to that system that we don't account for in any regulatory regime is the underlying instability at the household level when payment stops, when jobs come to a halt for a little while and you need a government payment to kick in, or when you're reversing back out of that. The idea that we could fundamentally manage risk at both the regulatory and the financial service level for the household and the economy simultaneously because technology allows us to, means that it calls for entrepreneurs. It also calls for the curiosity and kind of leadership at the regulatory level too, to kind of prioritize that simultaneous solving of problems. Because it's not just earned wage access. We have billions of dollars that leak out of retirement funds every time somebody changes jobs because of the way that system works, and it's not portable. The same kind of technology helps with automatic portability of retirement savings. The same kind of technology helps us understand how we could understand more about people's risks and pool risk for new kinds of insurance products. So the whole reason for calling for a national approach is to think about the entire toolbox being reinvented with the kinds of products and services that really help people focus on living these incredibly productive lives as producers, not just consumers in the economy.
Erin, you wanted to get in on that?
So think about, you said something earlier about the challenges of people, and you hear this story all the time. I needed short-term money because I had a car breakdown, a problem of expense. It's often actually a problem of income, right? So my kid was sick, so I missed work for a day. So I instead of getting paid for 2 days, right, I got 1 day off. A lot of people don't have paid sick leave, right? Kids in various points. And so you say, okay, well, the gig economy is going to solve that. So you realize that you're about to come up short. Your rent's due on Friday. You realize this on Tuesday. Ida made the point earlier about the financial knowledge and planning. People who live paycheck to paycheck do the most budgeting and planning. People who make 6 figures and live comfortably do far less. That's why financial literacy and giving somebody a brochure on budgeting is a pedantic and ineffective solution. They're budgeting more, right? But what do you than most families? But what do? Well, you go, I'm gonna drive that extra Uber. I'm gonna solve something on the gig economy. Well, then you're gonna get an asset, your future wage. But if that money isn't in your account and accessible to use by the time the payment is due, what good has that done? Right? So it doesn't surprise me that Uber was one of the first companies to start same-day pay. And one thing I heard anecdotally was that was more popular among their drivers than when they started allowing tips. And that corresponds with other data that's come in that shows that people living paycheck to paycheck prefer stability. If you say to somebody, would you rather be more certain in your weekly wages or get a 5% raise but be more variable? They'll take the certainty. Not because they don't want more money, right? This is America after all, but because they know that with certainty they can reduce their expenses. They're paying a lot of money because of this volatile life thing. And one of the things early wage access does is it solves for this volatility problem the way that same day pay or other solutions would have. Because otherwise we have a mismatch between possible solutions and the reality of actually getting that money in your account that's accessible.
Okay, so we have a supply side entrepreneur here. Just wanted to find a way to slip supply side in here. We are AI. We have a supply side entrepreneur who's offered this service, but you government thinkers, reformers, and I mean that in the nicest possible way. How do we get the government? The financial services industry, other than say probably healthcare, I don't know that there's a more regulated industry out there. So how do we get me basically go to the end of the process you're instigating? What does the regulatory framework look like so that we can have our cake and eat it too? We can have the necessary, consumer protections, but have the open space to allow supply side entrepreneurial solutions to the working poor, to the underbanked and the unbanked, because there are obviously unbanked as well.
Yeah.
What does it look like at the end of the day? How do we create this regulatory framework?
So, I'll be interested in Erin's piece of this, and Ram, yours too for that matter. But my own sense is that technology is changing what finance and what the financial industry is and who is a financial service provider so fast.
Yeah.
And what needs to happen alongside fintech is regtech, like regulators really understanding and what is the technology that underlines their ability to do things differently.
Is it more sandbox?
There's so many, I think sandboxes, even the allowance of, a lot of our research when we do a global scan of regulatory sandboxes it wasn't even just actually having the sandbox. It was having the regulator signal they were open to hearing about what your product was and what you were trying to solve for, and just learn, like there is a learning curve. And again, you've got regulators whose job is to manage systemic risk, safety and soundness. So part of this is the mindset pieces. When I think about the end goal, we have a very brittle and stratified and siloed set of regulators for every different kind of insurance, every different kind of banking product. Some of it's at the state level, some of it's you ask why the UK has done something and we haven't, even though there's a lot of parallels, we have such a complex system. So I often say, if you're gonna make an omelet, you gotta break some eggs. I do think that at some point we need to figure out not just another layer of regulatory complexity, but a fundamental disruption there about how we think about that. And at the heart of that, of course, the risk is consumer protection in the meantime.
Yeah,
What's really going to happen to folks? But it's hard to say the end goal right now because it does require a conversation among people who don't agree with each other, and that's where I think the leadership opportunity is right now.
So this is the rub. I mean, Erin and I at lunch were talking about TARP. He was a banking staffer there. I was a member in those days, and it was not a pretty time in American, financial services and the economy. And I remember talking to regulators frequently those days. Regulators don't get burned if they stop an innovation. They get burned if something falls, apart under their watch. So everything's a nail and they got a hammer. So how do you reverse that mindset and allow for this kind of innovation, which might end up with some kind of risk?
So I'll give you a great example of that, right? Which is that we have 5,000 banks, more than that number of credit unions. Fantastic, right? Let this competition, let this diversity go. I think regulators need to stop looking at overdraft as a source of profit for banks that make them less likely to fail and start asking the question, right? Are you a bank? I would have a regulation, no bank can make more than 50% of their net profit for 2 or more consecutive years on overdraft fees. Simple concentration of risk, right? From my research, 6-7 banks in America do that, and some of them make 100, 200% of their profit. Those are not banks. Those are check cashers with a bank charter operating a fee-based system, right? That's usurious. So, this AI conservative place, do you have an objection? You have a federal charter, right? Everybody who's banked is federally or state chartered with an imprimatur and government protection. You can't make your life based on overdraft fees. That's not your business model. Have a business model that's a majority profit from anything else other than one single fee. Regulators should put those banks, cease and desist, change your business model, or go
I get
away.
how that stops bad behavior, but how do you encourage innovation, risk-taking, entrepreneurship, new services? And how do you encourage that kind of culture among the regulatory class?
So look, first, I've been a big proponent that sometimes banks need to fail, right? The first year in American history where we didn't have a single bank failure? 2005. Second year was 2006. I remember on the Senate Banking Committee, the regulators coming up and saying, we did such a great job this year. No one failed. Look at how well regulated the system is, right? If you came to Washington every year and every restaurant was the same and nobody failed, is that the sign of... Now, you don't want systemic failure. You don't want a domino. The financial system's interconnected. We've lived through that experience.
Right.
We don't want to do that again. But there's a distinction between allowing for innovation and competition. Let some banks change their overdraft practices, see how the competitive market, let some fintechs come in, provide different services, right?
Yeah, that's the other thing. You got to give space for fintechs. They don't have to all become banks. Right?
No, right, and they don't. But if you take deposits and make loans, you're a bank. We separate banking and commerce in America, and I think that's a good thing. And we need to continue that separation, and we also need to understand that there's a difference between providing a service, right? Financial services, two words, services and finance. If you take deposits and make loans, right, then that's a different set of regulatory structure. But the other point I want to make on regulatory thing is we have a structural problem with the Federal Reserve. It's been given a lot of responsibilities, keeps growing, right? The curse of competence, right? They were doing also, right? And so should you be operating and regulating a payment system? Do you have a structural conflict of interest when America's asked you to regulate all the systems, but also operate your own? That's a structural conflict. And I think until we resolve that, either culturally by preferencing the regulatory side or legally by divorcing the two, you're going to continue to have a structure where they won't do their job as regulator until they fix their system as operator. And our operating system is so antiquated, right? I mean, it's not streaming or Blockbuster. It's not a VHS. It's like reel to reel.
So
I think...
Yeah, go ahead.
Well, I was just going to say that the whole vision for a commission is that there is an ongoing, not just to the end of time, but like where is a measured, structured place to have this conversation with rigor and inform it with data and come out with the answers to your question. I think that's the thing.
Society, we've got Web3, we've got all this technological
So much is
disruption.
coming. We can't fix financial inclusion, meaning helping with outcomes, unless we actually know what is the finance system 10 years from now? What is this disruption going to mean for households? And let's do that rigorously, and let's add the systems. I certainly don't mean to imply that managing systemic risk is not a core piece of it, but increasingly, if that is at odds with how the finance system facilitates people's financial lives, then we're not doing our job.
Let's ask the guy who doesn't come to Washington.
Yeah.
Who's not from Washington. What he just described as a bank, that's not what you are, and that's not what earned wage access is. You obviously saw a hole in the economy that needed to be filled, a need that was being unaddressed, and you've addressed this need, and you're addressing it right now. What presently stands in your way of deploying this further and address the question a regulator would think about when they see this new product risk? Where's the risk to the regulator?
The way I see it from my side is we have a product that consumers are using a lot, but it was never contemplated with the previous set of regulations. And so mostly everyone tries to fit it inside an existing box, even though it's something new. And for something that's very regulated, they're like, is it this or this or this? And if it's not, then it's suspicious. And because of that, there's so many consumer needs that are not being met. I know you spewed out 3 or 4 product ideas. When you were saying that, I'm not sure if you picked up on it or not.
Yeah.
I mean, the portability concept. If you could take your account routing number and move it to any bank, you didn't have to worry about switching banks because your direct deposit would switch, your bill pays would switch. Just think of how competitive the banks would be. And we have that with phones. You can point.
You can keep your phone number your whole life.
Propose that. the new vice chair for bank regulation at the Federal Reserve, Michael Barr, had a paper with Joe Valenti. I recommend that you guys read it. Who talked about exactly bank portability of accounts, right? When he was at the University of Michigan,
But he's in government now, so he's not doing that.
But I mean, imagine how non-competitive you'd be if the cost of switching your cell phone were losing your number, right? Totally different type of market competition unlocked by government requirement that they set up the switching thing. Otherwise, there would have been a dun-dun-day, we're not going to poach each other's stuff, and you'd have that. It's a perfect example.
So Ram, you're saying, I didn't want to finish your point.
So I think, like, for me as someone who's trying to, like, develop solutions, it's tough to do something if it's not fitting in the existing box. There's like no freedom to try things. Even if there's a very clear consumer benefit, it still needs to fit inside a box, and that the consumer benefit doesn't trump whether it fits inside a box or not. It's more important for it to fit inside a box, like overdraft has absolute regulatory clarity. Like, it's okay to do it, even though it's bad for consumers. But earned wage access is much better for consumers, but it's not clear how it's regulated. And so there's this like conflict between like some things are permitted but not good for people, and some things are good for people but not clearly permitted.
That's Ida, your effort.
Yeah, I think that this is the part. I think the one thing I would say about the cautionary note, and Ram, I think you've said this yourself, is you are solving for the person who has, and this is a wonky word, but it's illiquid, right? They need the money, they don't have the money. That is different than the other data that says that, not just are 40% of Americans living paycheck to paycheck. At the end of the year, they're actually insolvent, right?
Well, yeah,
there's less money.
That's a bigger policy.
So that's you can't fix all of that with tech,
right.
But to the degree that, for households that have well-being, you need to make life's fundamentals affordable. There's work that you can do to drive down the costs in the entrepreneurial space. You need to have that routinely positive cash flow. You need to figure out ways to make work pay. Benefits innovation is a huge space for solutions that are entrepreneurial. And at the end of the day, we need to help families do more than manage scarcity. We can't stop there. The whole point here is that people have durable wealth to decide for themselves how to live their lives and pass on the opportunity to their kids.
But addressing illiquidity definitely makes
it's a start.
difference in a person's
You can't talk
daily
about
life.
the future of wealth unless you grapple with the fact that an increasing number of Americans live in net debt.
Yeah.
And not in net debt that is about, I have a mortgage. It's net because of unpaid bills or fines and fees and things. People can often now get a bad credit score before they've ever had access to credit because of the ways that Ram, you saw
Overdraft
and are
fees,
solving
bills.
for.
So without opening into the bleeding heart inside us all.
We don't do that here. So,
But what's really infuriating is there are a group of people who are illiquid, who for whom the cost of this addressing their liquidity becomes so great in the cycle of debt and the payday lending traps and the rest that the actual cost of the system tips them into insolvency.
yeah.
And that part is so infuriating because there are some structurally insolvent people, you just can't figure it out.
That's something that he's solving with earned wage access.
That's one of the ways to do it, right? I mean, look, America was set up in part to allow for bankruptcy, to allow those who are insolvent to have a second chance, right? Bankruptcy's in our Constitution, right? Here we are, Constitution, right? Structured system, right? We were set up to allow the truly insolvent to have a second chance or another path in life. But what's infuriating is when the system drives the illiquid into the insolvent, which we have every day right
That's
now.
a compelling point.
Maybe I'll just share one story on, this is like what we see with consumers on overdraft. So we've seen a number of consumers who will, instead of paying bills on their card, because they'll get multiple overdrafts, they get one overdraft and take out cash. So they save on multiple overdrafts and they take the cash and they go to a same-day bill pay place where it's like $10 or $12. And so they know exactly what they're doing. They didn't want to get 3 overdraft fees. They take 1 overdraft fee and they pay 3 express bill payment fees. And it's like they completely understand how the system works and they figured out their way to kind of get around that.
And that marginal tax rate on that extra dollar is just
Mind-blowing.
mind-blowing. Let me open it up to the audience. And tell us who you are, if you don't mind.
Peter Sumlin with Capital Intel Group. Getting on the sandbox issue.
Go ahead, bring up the mic.
On the sandbox issue, you have the Tunisians that are doing central bank digital currency remittances using blockchain, which really beats the other bad player, the Western Union MoneyGram. Those are as bad as payday lenders. And then you have Africa, they've been doing mobile phone. Shouldn't we have our companies do this in Africa and the developing world before coming here? Because you see these mistakes of fintech with Brian Moynihan and Jamie Dimon are spending almost billions on stuff that doesn't work. We're still talking about it. Should it be Africa first where there's no, underbanking is really a luxury? Blockchain remittances are being done. You have the brain power to do this and do it now rather than trying to do it at home where our cost base and we still have payday lenders and all this. We might as well have the post office do banking at this point.
So I mean, I guess I would say, look, be very careful on that, right? America, a group of people in New York in the 1960s wanted to figure out a better way than going to the bank and getting a bunch of cash in order to go out to their restaurants with their wives over the weekend, and they invented this thing called the Diners Club, which today we call credit and debit cards. Plastic magnetic stripe cards, right? Invented in America, fantastic technology, exported globally, right? Visa, MasterCard, American Express, right? Discovered these are global companies headquartered in America, America intervention. Take your approach, right? China figured out with Alipay and WeChat Pay, right? Chinese Amazon and Chinese Facebook, because in China, the merchants refused to take the cards and the relative fees associated with it. And they digitized their money completely out of the banking system, right? And so that led to a whole different set of China. China's developing a CBDC, in my opinion, not because they're trying to take over the world view of the dollar, but because the Chinese government got very nervous that Jack Ma had taken over with Alipay Financial.
And they weren't surveilling. Yeah.
Well, yeah, and control is a much bigger issue there. But I would, America's financial services sector is one of our great exports. It's one of our great economic strengths. And we should be at the forefront of innovation, not at the back of it, because we're so afraid of what could possibly go wrong.
Other questions? Guy in the back of the tie.
Hi, I'm Elias Dorian. I'm a research assistant with a few other people here from Brookings. Getting to the last question you had, or the last point you made, it seems like the people who need real-time payments the most need it because they don't have roughly 2 weeks of liquid cash. So real-time payments might save $350 on overdraft fees. And while that's a lot, for most households, it's not 2 weeks of liquid cash. So my question is there evidence that people who have access to real-time payments build long-term savings so that they don't live perpetually paycheck to paycheck?
Ram, you see the evidence first and foremost. What's your take on it?
So we see that people come into earned wage access when they're at a time of crisis. And then when we look at their financial profile 6 months down the road, it's actually much better. It is a little difficult to disambiguate what's happening. Is it the timing issue because they came to us at a time of pressure, or was the tool actually helping them? But what we see is that there's fewer overdraft fees, there's bills being paid on time, and income's going up. Does that get them to where they're in a place where they're comfortable or not? It's tough to tell. The other thing that we see is that it's not like a one-off, like you're in a tough spot, you've recovered, and then everything is fine after that. Car breaks down again. Child falls sick again. These things happen again and again and again. So you need to be able to have tools that help you get back up on your feet.
Anybody else? Sure. The guy in the green.
Mike Golash, I'm from the ATU. The problem, it seems to be, the underlying problem is people don't have enough money to begin with. In other words, if you're on a paycheck to paycheck balance, you lose your job, you have an illness in the family, you have some sort of crisis, you're in big trouble. And until you create enough of a safety net and enough of a minimum wage for people so they can have enough to live reasonably, you're not going to solve this problem. So the problem is, they don't have enough income at the beginning to solve the problem.
Yeah, I think that's a much bigger policy conundrum right there. But the point being here is fintech can solve a lot of the problems that aren't being solved right now. Correct.
So look, there's a Jewish prayer called Dayenu, which says not to reject incremental solutions that make things better because they don't get you the whole way, right? We didn't solve the whole problem, so it's not good enough, right? No, celebrate each little bit of solution. I am very sympathetic to your point. on living wages. I'm very sympathetic to lots of different things in the income distribution that have gone wrong in this country that have a lot of different policy solutions. But one of the things we've observed that has cropped up, right? Overdraft wasn't a thing 30 years ago, right? There was a banker who figured out to reorder your debits and credits to maximize overdraft fee and got a giant bonus. There was a CEO of a bank in Minneapolis who named his yacht Overdraft.
You can't make that up.
TCF. Look it up. You know the institution up in the upper Midwest, right? They have the Golden Gopher Stadium. They have the naming rights.
Yeah.
His boat's Overdraft. Right?
Just so you know, they only have 10,000 lakes in Minnesota. We got 15,000 in Wisconsin. So, just wanted to put that on the record. Yeah.
So this thing is blown up. Why is it blown up? Because you have an exploitable population at a moment of necessity who have a system that is ill-designed for them, that was built to serve a very different system in the 50s and 60s, of very different workers with very different technology that hasn't been modernized. And they've successfully exploited it. There are more payday lenders in America than McDonald's.
But one thing that I think is interesting about fintech is it's not tied to a geography. It's not stuck in your zip code. Before these fintech solutions emerged in the scene, you got where you lived. If you lived in a town with nothing but banks with overdraft fees and payday lenders on the corners, that's where you went for those services. So one of the great things that this disruption is providing is geographical freedom for people to get out of these cul-de-sacs that are stuck with, to go get an earn-in app and be able to get their continuous pay.
Yeah, and when I'd add to your point and to your point is, I think technology, things are going to be disrupted, right? In the cycle of technological revolution in banking, and Erin can check me on this, inclusion to the end of better well-being has been a nice to have historically. It's until the forces of disruption align around that being an objective. Like fintech and the conversation about tech should be at the table along with the overall question of how much do people make? How much money? Where does routinely positive cash flow come from? But technology can be a facilitator. It should be at the table. A lot of the good problem solvers are there, but it's not going to happen by accident. Inclusion never happens by accident, and inclusion just meaning access to versus reaping the benefits of doesn't happen unless we take a leadership position on that, and it's not a partisan position. It's really one that is for every constituent in every place.
That's a great summarizing remark. Let me ask you,
Yeah.
I'm just watching the clock here. Aaron, and then I'll go to you, Ron.
So look, you asked earlier for solutions. Every bank should be required to offer a basic banking account with no overdraft fees, right, and online internet access. They're called bank-on accounts. It was piloted by the FDIC. Now it's now a national thing. 20% of Citibank's new accounts were bank-on type accounts. Thousands of banks offer these types of services, but it should be required. Again, having a bank is a privilege. It's a charter, not a license, right? For those legal minds, there's a big difference between getting a charter, which is the right to do something in perpetuity for a state-like function, and a license, right? If you have a bank charter, every bank has a charter, you should be required to offer this account. They're profitable accounts. It's not a free account, right? It can be, but it can have a small monthly fee. And that should just be a service that's offered. There are answers out there if you put having a working system as your goal. If your goal is maximizing bank profitability, you're going to derive a very different system that's much worse for illiquid people.
Ron, let me take us home. It's 3:13. In the House, we stay on time. We don't filibuster like those guys in the Senate. So we're going to stick our landing at 3:15. Give us your final thoughts on this.
I think it's kind of interesting in that, like, me being much more on the technology side, I'm trying to think of, like, what do you build that helps people that doesn't exist? And what I see this is more from the government side, is they're trying to make sure that stuff is fitting into what already exists. And like there's kind of like that conflict between the two. And kind of like if we want inclusion, almost by definition, we want something that doesn't exist. So we can't like at the same time want inclusion, but also try to keep everything exactly the way it is. And so it's kind of like accepting that the status quo is not acceptable, and like aggressively trying to find ways to get to a better place in the future.
I spent 25 years working on Capitol Hill, 5 as a staffer, 20 as a member. Almost every day having an entrepreneur come in from somewhere in the country saying, I've got a solution to a problem in society, but these laws and regulations don't let me do it. I could do so much more if this alphabet soup agency let me do this. And so it's always fun to watch an entrepreneur come into Washington and then hear, policy people talk. What's exciting about this moment I think we are in is the pace of change in financial technology, in fintech, in Web3, in just technology, whether it's AI, quantum, machine, all that's happening right now, it's so rapid that government is way behind on this stuff. But what you're showing us is there's a glimpse into solving a lot of problems out there, and that we can solve without creating some kind of, so we don't have that kind of TARP day like we did, back in 2008. So we don't have some massive systemic risk out there. So I want to conclude on the note that there are amazing things that are happening out there in the country. There are amazing entrepreneurial creations, engineering designs that are really solving some of society's, more stubborn problems that we have not been able to get over for quite a while. And I think fintech services, if you're taking a look at a country that's facing inflation, you're taking a look at how many people living paycheck to paycheck in this country. Again, it's you said 50%,
45 to 55,
45 to 50% living paycheck to paycheck. Serious problems that require lots of answers and solutions. But one of those things that is a real glimmer of hope out there are the financial services technologies that are being developed to fix a lot of these problems. So please join me in thanking these panelists for sharing some of their insights with us today. So thank you very much.